Just how great is Warren Buffett? On May 10th, 1965, Buffett took over the management and control of Berkshire Hathaway, which at the time was a struggling New England textile maker. From 1965 through 2021, Berkshire stock is up 3,641,643%, while the S&P 500 with dividends reinvested during that same period is up just 30,209%. The annualized return on that performance is 20.1% per year for Berkshire Hathaway versus 10.5% for the S&P 500. Assuming you had the skills to compound money at 20.1% for 56 years as Berkshire did, you would turn a $1,000 initial investment into an incredible $28.4 million. There have been investors that have had higher returns at times than Buffett, but no one has had the ability to year after year compound capital and consistently beat the market like Buffett has his entire career. So how did Warren Buffett become the greatest investor to ever live? Hi, I'm Sean, and this channel is all about the principles of investing. From stock tips to iconic billionaires, the best strategies, and our favorite tools, the Investors Podcast has everything you need to know. I listened to our new We Study Billionaires podcast host, Clay Fink, do an in-depth discussion on the influences that molded Buffett. Clay read The Snowball by Alice Schroeder and The Warren Buffett Way by Robert Hagstrom to form the basis of his insights on Buffett. He says it's unlikely that we'll become as great as the famous investor, but we can study how he invests and incorporate useful ideas into our own approach to investing. At the Investors Podcast Network, we strongly believe in learning from and cloning the ideas of investment legends. With this in mind, here are some takeaways about Buffett. First, be obsessed with reading and learning. It's well known that the Oracle of Omaha studies up to 6 hours a day and advises admirers to read 500 pages every day if they want to even follow in his footsteps. He says that's just how knowledge works. It builds up like compound interest. His habit of reading voraciously actually started at a young age. Buffett's father was a stockbroker, and young Warren spent countless hours at his dad's office consuming as many books on investing as he could. One book that greatly impacted him was 1,000 Ways to Make $1,000. He had committed at a young age to become very wealthy, and this book helped stimulate his mind to determine what makes for a good business. Start compounding early. Buffett's first business venture was selling packs of chewing gum to his classmates at the age of 6. He soon pivoted to selling bottles of Coca-Cola because of the higher profit margins, as he could earn a 20% return on his initial investment. He soon learned the power of compounding money over time, which is a key ingredient to his success. As Buffett has said, quote, "My life has been a product of compound interest. Nothing more, nothing less, and nothing brilliant." The book said that if you took that $1,000 and could earn 10% annually, you'd end up with $10,800 after 25 years. Buffett stashed all of his initial earnings in a desk drawer at home after realizing $1 today could be worth over $10 in the future. So understanding the power of compounding led him to become extremely frugal and mindful of his spending at a pretty young age. It was at this time that he set a goal to become a millionaire by just the age of 30. After being rejected by Harvard Business School, Buffett began researching other graduate programs and discovered that Benjamin Graham was a professor at Columbia University. Graham wrote The Intelligent Investor, which Buffett had reread several times and considered to be essential to understanding the stock market. So he enrolled at Columbia to study directly under Graham and picked up 3 main principles from him. The first principle he learned is that a stock is the right to own a little piece of a business. It's not a blip on a screen that investors just trade in and out of. It's actually ownership in a real company. Second, always ensure a margin of safety in your investments. Graham wanted to buy companies whose stock was selling well below its intrinsic value. A wide margin of safety serves as a buffer to protect against overpaying for an asset. And thirdly, Mr. Market should be treated as your servant, not your master. Mr. Market offers new prices every day. From time to time, he will offer a chance to buy at very low prices and other times to sell at a high price. Taking advantage of Mr. Market's moods is critical for long-term investing success. At the age of 26, Buffett moved back to Omaha after working under Graham and structured a partnership to allow family and friends to invest with him. At the time, he was worth $174,000 and didn't deviate from Graham's strategy of buying the cheapest stocks he could find, which were sort of similar to finding cigar butts that still had a few puffs left in them. Then at age 29, he met Charlie Munger, and they clicked and became instant friends based on a shared love of reading and investing. Munger was a lawyer but wanted the freedom of financial independence to do whatever he wanted. Munger understood Buffett's strategy of buying cheap, undervalued stocks, but he was much more interested in investing in great companies. He wanted to learn about a company's intangible assets, such as the strength of management, the brand durability, or how someone else could compete with them. Munger felt Graham's approach was quite pessimistic about the potential of the US economy and was incredibly conservative. Buffett himself was very optimistic about America's future, and Munger felt his investment strategy should reflect that and urged him to consider buying high-quality growth companies. In 1964, Buffett started coming around to Munger's line of thinking regarding investing in great companies and purchased American Express after the market had severely punished it. Buffett learned from Graham that when a strong company sells below its intrinsic value, you must act decisively. The American Express position tripled in price during the following 2 years. Another person that influenced Buffett to buy high-quality companies was Phil Fisher. Fisher believed that superior returns could be made by investing in companies with above-average earnings potential with highly competent management. As Buffett has famously said, quote, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Buffett also adopted ideas from Fisher about portfolio diversification. Fisher felt a concentrated portfolio of businesses that you know very well is far better than Graham's method of buying many stocks to hedge his bets. One of the main tenets of value investing is only to buy companies you truly understand within your circle of competence. Holding too many stocks makes it extremely difficult to understand every business thoroughly, and unless you do, a large market drawdown will likely shake you out of your position. We've covered the Oracle of Omaha's early years, but now let's turn the page to the next chapter of Buffett's life, where he begins buying shares of a failing textile maker called Berkshire Hathaway. The company was based in Massachusetts and trading at around $7.50 at the time. He figured the company's assets were worth around $19 per share if the company was liquidated, which is what he intended to do. Instead, he ended up owning the entire company, became its CEO, and turned it into one of the greatest capital compounders of all time. In the early 1970s, Buffett decided to wind up his investment partnership. Unable to find deals that met his investment criteria and worried that he couldn't produce the returns his investors had come to expect, he closed the partnership down. After 13 years, he had $100 million of assets under management and had achieved an annualized growth rate of 31% without a single losing year. Buffett was worth $26.5 million at the time. Buffett always wanted what was best for his investors and treated them like equal partners or even family. He was fully transparent in his communications with them and explained his performance, strategy, and what they should do with their money once the partnership was liquidated. As those of you know who have read them, Buffett's partnership letters contain a wealth of investment wisdom. Despite having retired from managing money on behalf of others, Buffett was still doing what he loved to do: analyzing companies he could buy on the cheap. Through the inflationary 1970s, stocks got pummeled. Buffett believed that owning stocks and companies with strong pricing power was the best protection against inflation, which was then running in the double digits. Investors flocked to gold, diamonds, art, real estate, and commodities to preserve their purchasing power. Everyone thought, quote, "cash is trash," and Businessweek announced the death of equities in an article. Meanwhile, with everyone avoiding them, Buffett wrote that it was time for investors to buy stocks. Many of his own holdings were down as much as 25%, but there was blood in the streets and he started buying Berkshire Hathaway shares until he ran out of cash. Buffett remained calm throughout the downturn and believed Mr. Market's opinion of a stock's price had no bearing on its intrinsic value. By 1977, Buffett's empire had ballooned to over $500 million. He controlled half of Berkshire Hathaway and 65% of a company called Blue Chip, and together they controlled ownership stakes in National Indemnity, Rockford Bank, See's Candy, West, 10% of the Washington Post, 25% of Pinkerton's Detective Agency, and 15% of Geico. As Alice Schroeder put it in her book, the Snowball, quote, "The great engine of compounding worked as a servant on his behalf, at exponential speed and under the gathering approval of a public gaze. The method was the same. Estimate an investment's intrinsic value, handicap its risk by using a margin of safety, concentrate, stay in the circle of competence, and let it roll as compounding did the work." Paul Volcker, the new Federal Reserve chairman, raised interest rates to 14% by the early 80s to get inflation under control. In 1981, President Reagan implemented tax cuts and started deregulating businesses. A bull market kicked in as prices of stocks started catching up with the growth in corporate earnings. In 1983, Berkshire bought out Blue Chip, which made Buffett and Charlie Munger full partners for the first time. Munger controlled 2% of Berkshire stock and became the company's vice chairman. Both took the job of stewarding other people's capital extremely seriously. Buffett was a big fan of media companies, and in 1985, he spent $517 million for 15% of the television company Cap Cities. At the time, this made him part of the biggest media deal in history. In that same week of 1985, Buffett yielded a $332 million profit from a single stock, General Foods, after Philip Morris took it over. At this time, he crossed the billionaire threshold at 55, a title held by only 14 people, according to Forbes. Buffett's star continued to rise, and he became the subject of more media coverage upon hitting billionaire status. Berkshire's stock price, which he originally purchased for $7.50, was now trading at $2,000 per share and up 26,000%. On October 19, 1987, markets worldwide dropped by 20% or more in a single day. But Buffett loved the moat that the brand Coca-Cola had established, and for years he considered the stock too expensive, at least until now. He felt the market had overreacted to the headwinds the company faced and loved the waterfall of cash that it produced. Buffett took advantage of the market correction and purchased 14 million shares of Coca-Cola for $600 million. Soon, the Berkshire stake in the company doubled to $1.2 billion. Other investors piggybacked off Buffett's moves, and at one point there was so much demand for the stock that the New York Stock Exchange had to halt trading temporarily. Coke now pays Berkshire $672 million in dividends per year from a quarterly dividend of 44 cents per share, which has doubled since 1995. Buffett once said, quote, "I try to invest in businesses that are so wonderful that an idiot can run them because sooner or later one will." Coca-Cola is an example of one such business with an iconic brand that practically sells itself. That's it for this video, guys. Thanks for watching, and let me know, what do you think of our breakdown of Warren Buffett's life story? We love hearing your thoughts, so tell us, what are your biggest takeaways from Buffett's journey to becoming one of the greatest investors of all time? If you want to track Buffett's investments for yourself, you can do so with our TIP Finance tool in the Legend Investors section. Just a reminder, nothing in this video is financial advice, and I'd encourage you to do your own research before making any investment decisions. And don't miss my video on the 7 habits of highly effective people, where I teach you how to build stronger relationships, live a better life, and focus on what really matters. See you all next time when we go over Buffett's moves over the past 30 years. We are conditioned then to respond to various stimuli and circumstances in our life. However, between stimulus and response is our greatest power, the freedom to choose our response.
This freedom to choose how we react to what the world throws at us is best captured by the story of a man held at the Nazi concentration camps, who reframed this suffering, despite torture and imprisonment,